Hey, Jason. So, what is really hot in estate planning, legacy planning, and doing the most for future generations that you can do?
Yeah.
What's one way you're helping people right now?
I tell you what's hot right now that we're seeing is just second to die planning, also known as survivorship planning, using two people on a life insurance policy because the leverage, it's just all about leverage. There's not an asset out there right now that can give you that leverage that the second to die planning can do because insurance companies don't have to pay that death benefit out until two people pass away. So we're just seeing people are coming to us. They're realizing that all of this qualified money that they have, all this pre-tax 401k, IRA money, it's the absolute worst legacy asset that you can leave behind because you got to cash it out now. You've got to cash that
Yep.
asset out in 10 years and you're just creating this huge taxable event one day. So why not start taking some smaller distributions from it now, leverage that into a second to die policy for the kids and grandkids and let them to be able to enjoy that money one day income tax free or have that death benefit sitting over there on the sidelines waiting to pay the tax bill on either a Roth conversion or whatever you're going to do with that terrible legacy asset that you're leaving behind of a big bucket of qualified money.
Go unpack that for a second, Jason. So, when you talk about
Mm.
using tax-free money, that you could do a second to die, and that cash during lifetime could be available for those things. Is that what you're getting at?
Well, exactly. I mean, if you're taking, I mean, one of the greatest things you can do is take an asset that the government's making you pay taxes on, through RMDs or whatever, or that you're going to have to pay taxes on down the road. Go ahead and take
Right.
some small distributions, have a lower taxable hit, doing those now, and
Mm.
use that money to generate a pool of tax-free death benefit that is going to give the kids and grandkids so many options. If you've got 500,000, $1 million sitting on the sidelines just waiting to be used. You pass away, that money drops to the next generation, that IRA drops. They could go ahead and do a Roth conversion on that at the time and have
Mm.
the life insurance sitting there to pay the taxes on the Roth conversion. Now you've got that money to be able to use tax free for the rest of your life.
Mm. So you can use it in the cash in the policy, drawing down from the death benefit, basically.
Right.
So that leverage that you're talking about, I know what you're talking about as an estate planning attorney. That if you're out there listening and your idea was that maybe you're gonna just leave a qualified account, 401k or IRA to future generations, very cumbersome for them to then try to deal with that upon death. Plus, you're not using that leverage very well, right, Jason? So if you take some withdrawals earlier, leverage those into a policy, get that death benefit. A lot of people don't think about that, and so I want to encourage people, if you're looking at retirement options, Jason being a retirement distribution expert among other things, uh, check it out. Check out
Yeah.
this option wherever you're watching. There's going to be a link you can connect with Jason to get examples and look at your own numbers, of course, and think about this second to die option. So another question may come up, Jason. What is a second to die, right? What does that mean?
So a second to die life insurance policy is just a policy on two insureds. So normally most insurance is done on a single life policy. This is going to be two people. And because the insurance company is not paying that death benefit out until both people pass away, you're getting a lot more leverage. Insurance companies realize
Mm.
they're going to hang on to their premium dollars a lot longer. So the the internal rate of returns on these policies are just massive. I'm talking
Mm.
20 years in, guaranteed internal rate of return, even tax equivalent, because you have to think about it, since they're going to receive this death benefit income tax free, that you're looking sometimes even 10, 11% internal rate of returns 20 years into these policies. So
Mm.
you take two 70-year-olds 20 years out, life expectancy of 90, and still getting a 10, 11% rate of return on your money. It's just not any stock bonds or mutual funds that can guarantee that.
So that's the leverage that you're talking about. And
Yeah.
of course, the earlier that one might die, the higher that internal. Even 20 years out, you're pointing out that it can be in the 10 to
Yeah.
11% range. Jason, thanks for bringing this up today.
Yeah, man.
And Appreciate you all joining us today, and we'll see you in the next one.